it started off with a speculative boom. House prices zoomed up, stock market prices zoomed up. And this after the dot-com boom collapsed, and this was a second speculative boom that came before the immediate crisis we're talking about. There was the subprime crisis, which we need to talk about a bit. The credit crunch, we lived through that. This led to and triggered a banking and financial crisis. This triggered into an economic crisis, which triggered into a sovereign debt crisis, which has left us with the seemingly only one policy on the table, and that is austerity. Doesn't seem to be any other policy we're being offered at the moment than austerity. So I'm going to look at the different aspects of these. Now, it doesn't really follow as logically as that. These are twisted round each other. They happened alongside each other, but they're the different aspects of the crisis that we need to think about. Meltdown. When did it all happen? Well, I suppose the first thing we think of in this country, although it wasn't the first symptom because some hedge funds failed, but in France. But I think what brings it home to us in this country was September 2007 and the run on Northern Rock. And that's the first run we'd had since I think something like 1866 or something, when a bank failed. So that was unheard of, a run on a bank. And it happened, of course, in our own region, or at least based in our own region. Then everything seemed to go back on not exactly an even keel, but it limped on until the next and the biggest of the crises, and that was September 2008 when the investment bank Lehman Brothers failed. Now, this failed because it asked for a rescue from the US Treasury, and Hank Paulson refused to rescue it, mainly because the only interested bank who was interested in buying it was Barclays, and the British government wouldn't let Barclays buy it unless the American government put up money. So this wasn't the least bit about being private. This is a private bank, a private sector bank, an investment bank that failed, and yet the discussions were all about, will the government bail it out? Paulson said no, which is the logical thing. It was an investment bank, it wasn't a high street bank, it wasn't a deposit-taking bank, it was an investment bank. And logic would say, under capitalism, things fail. But what was found was, when they let Lehman's fail, it nearly brought down the whole financial system. So it showed that the idea of the concept of the private wasn't very meaningful, that a private sector investment bank could bring down effectively the banking systems across a good part of the globe, particularly North Atlantic and European. Then we stagger on again. They get back up on their feet again with a lot of government support and government help, and they stagger on another couple of years until the impact starts to come onto states themselves. And we get it by May 2010. We've got the Greek bailout and the Ireland and Portugal bailouts, and that led to a euro crisis. We'll go into all of this in a bit more detail, and then we're still in that crisis. The euro, whether it survives or not, is in the lap of the gods at the moment, if the gods are Sarkozy and Merkel. But and really, as I'll come on to tell you, the reason the euro crisis is in such a situation is they don't understand money systems. They've designed a money system as if money is a hard thing, and they haven't understood the social nature of money. And therefore, they're trying to, the ideology when the Eurozone was set up was very much a neoliberal monetarist kind of ideology. And they're paying the price now. And then in August 2011, even the United States loses its AAA rating as a country. And not that it makes any difference for people putting their money into the United States, because they've got nowhere else to go. In fact, people investing in some government debt are taking a loss because the money just has nowhere safe to go, and the only safe place they feel is governments, and they'll take a loss to leave their money with governments. In fact, the European Central Bank has put about 500 billion euros into circulation just recently, or at least made it available to banks as cheap loans. the banks took the money and then they've deposited it right back with almost the total amount of money has been redeposited with the European Central Bank. So basically the money is just going nowhere. And we're still in a crisis with no end in sight. There's no end to the Greek crisis, no end to the Euro crisis. We're only, in terms of austerity, Greece is in a horrendous state with austerity. They've had, how many budgets in Ireland? Is it now 5 austerity budgets? And there's still no solution. We haven't even started our austerity package yet. We're as Polly Toynbee said, anybody saw her article, we've hardly touched it, we've hardly scraped it. So there's a long way to go and a long way down to go. Let's think about that boom then. Well, one of the main things was a house price boom. If you look at the money that went into the economies, particularly Britain and America, in that boom period, nearly all of it was associated with housing and mortgages, particularly equity release. That boom was almost done by people taking out second mortgages. A really big part of it, as people expanded the money supply, as they released money from the value of their house to spend on other things. It was also encouraged by obviously the boom in cheap consumer goods, and therefore encouraged people to buy and consume because things looked so cheap. Very easy credit conditions, very low interest rates, mainly because of the recovery from the dot-com boom and the crash. Lax bank regulation and that bonus culture, very important, that sense of pushing people to maximise money transactions, money investments as much as possible. And a general feeling of optimism and exuberance. So take on a big mortgage, take on debt. But of course, there's other debts people couldn't avoid. Things like student loans became very important. And I understand that student loans are likely to overtake mortgages in the United States before too long as the biggest source of debt. So people had no choice but to take on loans. But with taking on loans, they got used to it. Students were coming out with a lot of personal debt of various sorts. But one of the weak points that brought the system down was subprime lending, particularly in America. And why so important in America? We have things like Together loans here, Northern Rock, of course, lending 125% of the house. But it was much more important in America, and mainly to do with a deregulation of mortgage lending. This meant that a lot of mortgage companies set up, and they were giving out what they call these liar loans, in the sense that they were giving loans to anybody who asked for them. And they're known as ninja loans, no income, no job, no assets. People were just, people who'd never thought really before of taking on loans were encouraged to take them. And the reason for this was because of a change in attitudes towards mortgages in the States. The States had always had a very stable mortgage market. Loans were long period loans, 20, 30 years. They were backed by government agencies which had been privatised, Fannie Mae and Freddie Mac. They were backed, but they were state agencies really, offshoots of state agencies. And people were used to a fixed rate mortgage. You took your mortgage out, and for 30 years you paid whatever interest you paid at the beginning, you paid right through your 30 years. And that's what people were used to. And they didn't realise when they got these teaser rates, that is very low rate mortgages, to encourage them to buy their houses, often or to remortgage their houses. Often it was remortgaging that they were doing to pay college fees, to pay health problems, to put in investments. The mortgage brokers gave them a very low rate of interest, and people had assumed, because it always had been the case, that this was for the whole period of the mortgage. They didn't realise that it was only sometimes for a month, sometimes for a week, before the mortgage rate shot up. So you understand the psychology of the American people taking on these loans. They were fooled into taking on loans because they hadn't realised that the rules had changed, and that rates could be put up, which they weren't allowed to be before. But the main reason there was this expansion was this originate to distribute attitude to loans. That is this selling of loans. Loans, people's borrowings became an asset to be sold and invested in. And that was the big change. So two big changes, the move from fixed rate mortgages to variable mortgages, and then this originate to distribute. Basically, if you sold a mortgage on, then it didn't matter how good a mortgage it was because it wasn't your problem anyway. So mortgage brokers would sell as many mortgages as they could. They would then sell them to the banks who would buy them off the mortgage brokers, and then the banks would bundle them up and sell them on. We'll come into that in a minute. But it wasn't just mortgages. All forms of debt were expanding. Like I say, student loans, personal loans, consumer loans of various sorts. So debt was growing big time. So the levels of debt were really going up. Look at some examples. The US financial sector in 1981 was 22% of GDP, equivalent to 22% of GDP. By 2008, it was more than 100% of GDP. It was 117% of GDP. So that's the borrowings by the financial sector to invest in financial assets of various sorts. Household debt also went up. 1997, slightly different base, 66% of GDP. To 2007, a 10-year period, went up to 100% of GDP. So put those together and you've got over 200% of GDP with the financial sector and household sector alone. If you add in all sectors, including government sector, then the overall levels of debt in the economy go up from 1980 of 160% of GDP, goes up to 350, so it doubles by 2008. But Britain's much worse position. All sectors in Britain, 1987, 200% of GDP, 2009, 540% of GDP. We're over, and we're still over 500% of GDP. So the concerns about government debt really is the least of it. The debts in the rest of the economy are much heavier. And although now all the fuss is about government debt, the real debt is actually household debt and an indebted population generally, and particularly financial sector debt. So it's the bank's own debts that really are the big issue, and this is what we're just not talking about. Household debt in the UK peaked at 150% of GDP. Obviously it's going back somewhat because people are paying off their mortgages as fast as they can. So that's how much debt grew. Where did all that money go? Well, in the UK, I think we might have seen this slide before, UK money supply doubled between 2003 and 2009, and 3/4 of the loans were linked in various ways to property, and 30% of those loans went via the financial sector, to the financial sector, via the financial sector, and only 20% of that money went to the manufacturing or non-financial sector. So basically, most of it was involved in the financial sector, and the majority of it related in different ways to housing, mainly mortgages. So the other side of it was this business of trading in debt. Now, traditionally, most house lending in both Britain and America was through specialist agencies, building societies in this country, savings and loans, local lending agencies. Not really, the high street banks weren't really involved, and certainly the investment banks weren't involved. This changed in the latter part of the 20th century, and this was part of deregulation because banks weren't allowed to get involved in many cases in mortgages. But the banks, and particularly the investment banks, got involved with mortgages and started to use them as assets to be traded. So investors could buy a mortgage as an investment in the same way as they could buy a share on the stock market. They could buy a mortgage as an investment, that is a mortgage-backed security. So they're buying somebody's debt, and obviously they would get their money back either by selling that debt on again or taking the profit as that debt is repaid. But of course people don't want to hang on for 20, 25 years to wait for the benefit of it, so they tend to treat it more as an asset to be sold on, like you sell on your stocks and shares. So this process was known as securitization. A securitization is paper ownership of an asset which can be bought and sold. So if you think of these mortgage-backed assets, or debt-backed assets generally, if you think of them as a share certificate, if you own a share in a factory, you don't have to sell the factory to get to trade your share. You can just trade the notional ownership of it. You trade the share certificate. And it's the same with these mortgage-backed securities. You traded your ownership of the underlying mortgage. And it wasn't just mortgages, it was all kinds of debt: consumer debt, student debt, car loans. They were all bundled up, and they weren't sold individually, because obviously who wants to sell an individual loan for, $30,000 or $100,000? You don't want to deal. You want to deal with bigger packages than that if you're an investor. So they were bundled up and sold as packages of loans called collateralized debt obligations, CDOs. So you bought a bundle of debt, and that's really where the problem really came in. What happened is that these the process that followed the securitization was known as slicing and dicing. What happened was you had a bundle of debt, and you didn't buy the whole bundle. What you bought was a share in the bundle of debt, and so so you're already buying packages of titles to debt, and now you're buying part of the package, the title to debt. And the reason for this was that obviously some debts may not be repaid. There's always a risk. So the idea was that you got a different rate depending on which bit of the debt you bought. So if you bought the most secure debt, you would make less money. You get less interest for your investment. And if you bought the most risky debt, you would get a higher interest rate, because obviously you've got more of the debt. The idea was that it's unlikely that 100% of the debts would fail, and so therefore you'd assume, say, the bottom 10% could possibly be failed. So the people who invested in that would get quite a high interest rate. Whereas the people who took the top tranche, which means the first lot to be paid out, they would be guaranteed to be paid. Now, this is important because if you're the major investors in most financial assets are building societies, pension funds, insurance funds, what are known as the institutional investors, and they cannot afford to lose. They can only, by law, by their kind of constitutions, have to invest only in the safest possible things. Therefore, they must have this precious AAA rating. And this is important with government loans as well, because government debt, as soon as they lose their AAA rating, the big institutions can't invest their money in them. So that becomes quite important, because quite a lot of government debt is held by big institutions, because it's one of the safest forms of finance. So it's a big issue. This AAA rating is a big issue. And so what happened was that it was assumed that the least well-paid part of the tranche was the safest, and it would get the AAA rating. Now, the AAA rating was given by the rating agencies. And one of the big scandals of this whole situation was the rating agencies weren't independent. They were paid by the people selling the debt. So they pay the rating agencies to rate the debt they are selling. So, of course, now, if you want another contract, you're not going to say, look, this is dodgy stuff. I wouldn't be selling this if I were you. Because that's your money. That's where you earn your money. So there was the rating agencies just were not independent. And therefore, their ratings were, well, questionable, should we say that? But in addition, of course, if you take out an investment like a debt, you want to have another safeguard. So another thing that arrived were credit derivatives, whereas people who invested money in debt would also take out a kind of side bet, where they would take out an insurance on the debt. And these insurances became investments themselves, so they started getting bought and sold. And they were traded, the phrase is used over the counter. This means that they were traded in private arrangements between organisations, between banks, insurance companies, investment banks, high street banks, hedge funds. They're trading this insurance. They're all taking out the insurances. And they became known as credit default swaps, CDSs. And these were done. So there's no regulation of this. There's no stock market in which these done. None of this debt, in fact, is done through any regulated form. So nobody knows who's buying and selling what to whom. And it became, and it made insurance companies who took on this insurance very dodgy. So within days of Lehman Brothers collapsing in September 2008, world's biggest insurance company collapsed as well, AIG, because it was holding a vast amount of insurance of all this debt. And it needed a huge bailout, £170 billion bailout by the American government. It's an American company. But in fact, a lot of the dodgy credit insurance was run through the London office because London was less regulated than New York. So a lot of the trouble came through a London office. So basically, it became a massive industry. This debt all pivoted on people's second mortgages and these very uncertain the credit that's being lent, and this massive amount of credit people were taking on. Now, the derivatives, these credit derivatives, were part of a much bigger thing of what's known as derivative trading. And in terms of credit derivatives, these insurances, you could take them out even if you didn't hold the debt in the first place. Now, how this was allowed, I've got no idea. But you could be, you're a hedge fund, right? And you want to make an investment. So you think, oh, I'll insure Greek debt. I'll pay a fee and I'll insure £100 billion worth of Greek debt. That's an awful lot, £10 billion worth of Greek debt. And so you pay quite a fee to an insurance company to insure £10 billion worth of Greek debt. But you haven't got any Greek debt. You don't own any of Greek debt. This is what's known as naked credit default swaps. And there are heaps. This is one of the reasons why they can't let Greece go. Because there could be untold, nobody's been regulating it. So there could be many insurances taken out by many people around the world who've never even looked at Greek debt, let alone invested in it or borrowed it. So you're getting so distanced now that you've got the poor person who's paying all the austerity somewhere or the mortgage or something down there. You've got that debt being sold, you've got it being insured, and then you've got it being insured by somebody who has nothing to do with it at all. So at least some of them have something to do with it. But who knows how many insurances there are out there, because nobody would be letting on. Nobody would be saying, oh, I'm sitting on so many billions of pounds worth of Greek debt insured. Everybody's sitting, crossing their fingers and hoping that the whole problem will go away. So default on debt now, because these credit default swaps were allowed where people didn't hold just as a pure gamble, people didn't hold the debt in the first place. It means that, and of course those people are quite keen on default, because if everything defaults, they get paid. Whereas the people who hold the real debt are having to take what they're calling the haircut. They're having to take a 70% cut in what they get. So the people who actually are standing holding the debt certificates at this moment are having to take a 70% cut, say, on Greek debt. The naked credit default swaps holders can take 100%. They can get 100% because they don't hold the debt. So we've got in this crazy situation. And you've also got debt vultures going around, people who are buying up, say, third world debt, the remaining third world debt, and buying it up at a cheap rate because the lenders know they're not going to get their money back. And then they're going to those countries and demanding 100% payment. So there is a horrible situation going on where people who didn't make the loan in the first place, had nothing to do with it, are either insuring debt they don't own, or they're buying up people's debts cheap and then chasing them for the full amount. So there's really horrible situations going on. But this whole credit derivatives markets grew from $108 billion in 1995 to more than $1 trillion in 2006. And by 2007, look how rapidly it grew. 45 trillion in 2000. It just grew like topsy. And it was nearly equivalent to world GDP. So there was this great boom in these strange investments, and no regulation at all, because nobody was watching what was going on. Now, there was so much profit to be made in this new securitisation, the buying, the selling of the debt, the insuring of it. It seemed to be easy money. You just took you just took some of these gambles. People paid you a fee to insure so much debt. People didn't default on debt, so it was a safe bet. And the banks started to make so much money that they started to what's known as outstrip their capital adequacy ratios. Now, I'll explain what they are. Banks are supposed to have sufficient capital to allow for some losses on their assets. That is low defaults. It's expected. Banks are going to lose some money. Some people won't pay their debts. That's acceptable. So banks are supposed to have enough money in the kitty, readily accessible, to, as it were, plug the gap. If everybody wanted their money back, well, you couldn't do it, everybody wanted money back. If a substantial number of people wanted their money back they'd invested, they would be able to draw on their capital reserves and pay out, and they would therefore be solvent. And bank capital is made up of two things: retained profits and any money you've raised from selling shares. So that's the money the banks hold. So, and you're supposed to have a ratio between your total assets, that is the total loans, the total investments you have, and how much capital you're holding. And usually it's thought of being somewhere 8%, 7%, 6%, 5%, 4%. It moves about, but it's that kind of range, under 10% anyway. But so, because the assumption is you're not going to lose 10% of everything. That would be a very strange bank. And of course, there are many strange banks at the moment. So banks solved this balance sheet problem because they wanted to have more and more and more of these assets. So what they did was they put all their investments in these strange beasts that were coming up, these securitized loans, credit default swaps, all the other things they were holding. And they dealt with it by shadow banking. That is what they did, is they set up a separate company. Now, apparently, how this happens, I've no idea, but as long as you've got 3% of external investors in these, what became known as special investment vehicles, you can count them as not being on your balance sheet, even though 97% is owned by the bank. As long as there is some private ownership of these sort of investment sort of entities, it doesn't count as being part of the core balance sheet. So what they did was they all set up these. I think Northern Rock had something called Granite, which was where it held some of it, where it held its mortgages in this offshore. I think it was in somewhere like Jersey. They had a company called Granite which handled most of these things. I may have got that wrong, but I think that was the case. It's in the book, but I've sometimes I've read that. So capital adequacy is supposed to be 8%, 6%, 4%, a percentage. But if you took account of all these special investment vehicles they were setting up, if you put them back in to the balance sheet, the capital ratios fell to nothing. Somebody worked out in America that it was 0.001 or something, because there was so much money held in these funny entities that in fact there was very little capital underpinning it all. So if it started to go wrong, they were in trouble very quickly. And as a result of all this, if you added up what the total bank balance is, there was so much money being issued, so many loans being made, so much being bought, so much being sold, massive amount of debt money being issued, that the bank balances, total bank balances, were growing bigger than GDP. Even today, RBS's bank balance sheet is equivalent to our GDP. That's just RBS. Is the same size. The balance sheet of RBS is equivalent to our GDP. I mean, that's how big they still are. But they grew massive. Iceland, which of course failed dramatically, their bank balance sheets were 10 times GDP. And I think we're probably still round about this, 5 times GDP. Ireland was about 8 times GDP. So if you're underpinning, let alone, so think about that's GDP. That's not even tax base. That's GDP. And what is holding up this system now? It's the tax base, which is a much smaller thing than GDP. So it became, they just became out of control, completely out of control. And the financial sector, therefore, were growing dramatically. The US financial, if you look at manufacturing in America, 29% of GDP in 1950, down to 12% in 2005. Financial services, on the other hand, goes from 10% to 20%. But not so much if you take out all the mortgages. If you take out the real estate, it shrinks. And for both Britain and America, it was a very big part of the boom. The boom year was really down to financial services in various ways. What went wrong then? Well, high levels of default, particularly in America, because people took on mortgages they couldn't afford, and they were stung by these teaser loans. So people started defaulting within 3 months. They were defaulting within 3 months of taking out a mortgage. That was unheard of. Also, house prices started to fall and made the certainty of being able to get your money back much less likely. The bundles of debt-based securities, because they weren't regulated, weren't carefully screened for risk. There was so much money to be made. People were just, because of course subprime mortgages paid high interest rates, and therefore they were a good investment. But of course they weren't screened for risk, and because they were all bundled together, nobody knew how high up the bundle did the risk go, and therefore it infected the whole bundle. So even the people at the top AAA rating didn't know that their bundle was safe. So the financial institutions and insurance company had to back off. They couldn't get involved. They had to stand back because they weren't sure if they were still AAA. And therefore the banks were left not being able to sell the debts on. So they ended up being stuck with a whole tranches of debt they couldn't sell. And the whole thing started to seize up. So as defaults occurred, the flow of debts and investments stalled, and this led to the credit crunch. No banks were willing to lend or support money to any other. Banks lend money to each other so they can, at the end of each day's business, they do their accounts, and if they're a little short, they borrow off another bank if a bank's got a little bit more. Because in the whole system, the money's gone somewhere. So if money's gone out of this bank, it's gone to another bank. So basically, they equalise by lending money to each other to cover to balance their books. But that ground to a halt. And that credit crunch put a lot of institutions on the edge of bankruptcy because they couldn't get loans from anybody and that's what happened to Northern Rock. It couldn't get any loans to cover itself, and it wasn't sure, like most people weren't sure, how many of its mortgages were actually now toxic, how many were unlikely to be repaid. So it's not a case that everything was toxic, but the point is they didn't know what was toxic, and therefore everything became contaminated. And all types of banks were affected. Public banks were doing this, building societies were getting involved, less so than the mainstream banks and the investment banks because they're more regulated. But even so, everybody was on the bandwagon a little bit because there was so much money to be made. So it seemed to be a good idea. So what happened, of course, is we know what happened. The states had to step in. The public money, the public notion of money, which we've been talking about in previous sessions, came into its own. So what did the states do? Well, one of the things they did was guarantee bank deposits. In Ireland, and this is where Ireland got in a lot of trouble because the government immediately, to save its banking system, guaranteed all bank deposits. And that was equivalent to 2 times GDP. Total bank balance sheets are even bigger, but just deposits, just people's savings, were twice GDP. So Ireland had committed itself to twice its GDP in saving people's deposit accounts. Central banks issued loads of cheap money, which of course fueled other kinds of booms and allowed the party to go on to a certain extent, and also has led to things like higher commodity prices, which is a big problem. But sometimes they had to outright nationalise banks, or at least put a substantial amount of capital into banks, and countries around the world had to do that. At one stage, you could buy all the American banks for some ridiculous sum. Their capital rate had gone so far down and their share prices have fallen so far down that you could buy them for, a handful of £1 billion. You could have bought the whole lot. It was that bad. I forget the figure now, but it was a ridiculously small amount of money considering the amount of money was being guaranteed. There was a lot of governments setting up toxic asset purchase or insurances. So the governments would buy these debts and issue money in their place, or insure the debts, say they'd stand behind them to try and there was, a lot of states also expanded the money supply themselves through this process called quantitative easing, where they just made money available to the banks, unfortunately, to come out as lending, which of course did no good at all. As we know from where we've been talking about before, they should have spent that money straight into the economy. That's what they should have done with it. But they put it in the banks and it stayed there, as the Eurozone has found when it put its 500 billion euros in, and it came straight back in to the bank. So that money effectively virtually went nowhere. So supporting the banks and the wider economy, because we've forgotten that states can issue their own money and can spend money themselves directly if they have control of their own money supply, the states are having to borrow money. And this has led to what's known as the sovereign debt crisis. And who are they borrowing off? Well, they're borrowing off their banks and their institutions that they're saving, which is crazy. They're borrowing off other states. One of the big areas of growth are sovereign wealth funds. Countries that have not been profligate and countries that have, like China, which has got a big export industry, or the oil-rich states, or places like Norway that were sensible to be careful with their North Sea oil, they have got government investment funds, and quite a lot of the money is actually governments lending to other governments. This money, but basically, this has led, as we know, to a sovereign debt crisis where states have had to take on debt. Like I say, I think that's totally unnecessary for them to do it, but the ideology is that states can only borrow off the financial system, which means they allow the financial system to create money, which they then borrow and have to pay back, which is, if you remember what we've talked about of money and banking. So why did the crisis happen then? Well, all those financial innovations, such as securitization, high levels of leverage, which I'll talk about in a minute, borrowing, the bonus culture that encouraged risk and rapid turnover. The bonuses aren't paid on profits, they're paid on turnover. So the more you do, there are fees. Every time things go through, fees are paid. And therefore, it's in the interest of anybody in that business to turn over as fast as possible. Turn over the stuff as many times an hour as you possibly can. Lax regulation, obviously the regulators didn't see the risk, particularly of shadow banking. They didn't realise what these investment vehicles were being set up. They were being shown clean balance sheets, and they didn't know all these special entities that were being set up. It was obvious you couldn't isolate parts of the system. They tried to let layman's, which wasn't that, it was a big investment bank, but it wasn't the biggest bank in the world. And it was an investment bank, it wasn't a high street bank. They tried to let it fail, and it nearly brought the whole system down because of nobody knew who held the debt. I think it was about £600 billion that Lehman was involved with. Lehman was worth, I think, considerably more than the debt the Greeks owed, considerably more. And the banks, even Lehman, was too big to fail, and some of those were much bigger. Things like Citigroup and the great big banks, they're too big to fail and probably too big to save. Let's talk about this thing called leverage, because that was very important. Leverage is another word for debt, but there's different ways you can do it. Now, one of the ways they did it was this business of reducing the ratio of capital to your investments. So you're pivoting a huge balance sheet, as I've been talking about with these special investment vehicles, on a very small amount of retained capital. So if things start to go wrong, you've got no buffer effectively. So that's one way you have, and so therefore the capital ratios in that case could go to 30 to 1, 40 to 1, 50 to 1, some say 100 to 1. Depends how you calculate it. Another way they did it, and this was very much what hedge funds did. Hedge funds are kind of special funds set up by very rich people, usually a minimum £1 million investment, to gamble effectively on derivatives, on all kinds of derivatives, on the buying futures, gambling on share rise and falls, gambling on debt payments. As people say, you can bet on anything. And what these companies do is they have, say, £1 million invested, which they're going to invest on a movement in the stock market that's going to be a very small movement. So the profit's going to be very, very slight. It's going to move, they're going to make perhaps 2% on that £1 million. So what they do is they're going to do it very quickly. They're going to turn this over very quickly and make this 2% in a very short time. So they borrow, say, 10 million for a very short term, pay a fee to borrow 10 million. They then put a bigger bet on, effectively, 11 million now instead of 1 million, and they get 2% on the whole lot. So that becomes a much bigger profit. They then pay the fee to the bank they've borrowed the money off, they've borrowed the 10 million off short term, and now your £1 million has made a good deal more than 2%. Do you follow what I'm saying? Yeah, and that's what they were doing. But of course, if those deals went wrong, and of course they did go wrong, Enron went wrong, long-term capital management in 1998 went wrong, Enron went wrong in 2001, massively wrong, billions wrong, and the banks had to take the hit. So even though they'd seen it happen, this was still going on. The other thing you can do is do what they call buying on the margin. Again, hedge funds would do this a lot. That is, you put down a deposit on a say you agree to buy some shares momentarily because you think the shares are going to go up or down. So you short them by selling shares you haven't got, or you buy shares if you think they're going to go up, and you short them by selling shares you haven't got if you think they're going to go down. You can buy them more cheaply. But you don't put the money on for the whole share. You put a deposit on the share, saying, right, we're saying we're going to buy, 100, 1,000 shares or something. You say you're going to buy them, but you only put down, say, a 10% deposit, and then, provided you've bet the right way, you can make quite a lot of money for a small outlay. Unfortunately, if it goes the wrong way, you've got to cough up. You've got to buy the full price of the shares. So you make a lot of money if it goes right. You lose a lot of money if it goes wrong. So all this was going on. So people were pivoting big gambles on quite small amounts of core money. And that's how the thing grew and grew and grew like Topsy. So I've just been explaining this. Hedge funds using borrowing to enhance on short-term trades, and often relying on computer-based trading. The so-called rocket scientists. Now, the trouble with this computer-based trading is that obviously every company is setting their computers in the same kind of way. So there's a chance of a huge sweep movement as all the computers go at once. And a lot of the trading now is done on just computer trading, not even a human hand in it. So if the calculations go wrong, if the program goes wrong, then again huge amounts of money can be lost. I've just talked about long-term capital management, which was one of the first hedge funds. The people who set that up won the Nobel Prize for supposed to be anticipating risk, and it failed very quickly. And Enron, of course, which started off as a pipe-laying company, then became an energy speculating company, just buying and selling energy. Another thing that's sprung into, with all the cheap money around, are private equity companies. These were using borrowed money to buy up companies, and like the Automobile Association, the AA, Boots, one of the really big ones, I think that was 11 billion. Debenhams, EMI, which went very badly wrong, EMI, that lost a lot of money. And the aim is to buy up companies and football clubs as well, Manchester, Liverpool. The idea is that they use borrowed money to buy the company. The borrowed money then becomes a debt on the company, and then they take their cut, they take their profit, and then they aim to sell on the company with its debt as well. So a lot of things going on with the use and the manipulation of debt. So financial investment effectively became detached from any interest in accumulating capital through productive activities. The financial sector became everything. And we started to confuse money speculation with wealth creation, with a great impact on actual productive investment. That started to go down. And speculative investment in financial assets, stocks, shares, bonds, derivatives, mergers, acquisitions, the private equity area, this grew massively, so it became worth 10 times world GDP. It became massive. So in the same way as you got state GDPs, where the financial sector was 10 times, as in the case of Iceland, state GDP, it also got 10 times world GDP. GDP is all the goods and services that you've got. It doesn't count the financial sector. But the trouble with this is you get on this treadmill where speculative investment can only realise a profit if the asset's sold on. So you've got the problem that you need new money. Although there's oodles of money floating around, you only make money if you can actually sell your debt or sell your share or if you're trading up and down the stock market, if you can, or sell your house in that sense. You can only liberate your money if you can do that, and that requires more money coming into the market all the time. So we're constantly looking for more money to come in. So effectively, it's kind of a chain letter system or a pyramid scheme. There is no real consumption, there's no real production, there's nothing really there. It's just, in a sense, just waiting for the next tranche of money to come in to bid up the price of what it is you're selling. And there was vast room for fraud and deception. I mean, Madoff kept it going. Do you remember him? He went on for years selling to his friends and just paying people out of the new money coming in. And of course, eventually, the money stopped coming in. It had to fail at some point. But in a sense, the whole financial system was one big fraudulent scheme, because it was only going to keep making money if more money kept coming in, which meant more debt. And of course, as soon as people stopped taking debt and stopped making the investments and the banks stopped lending, then the whole thing crashed. But the banks had a problem because people had traditionally put their savings and their retirement schemes and things in mutual schemes, in more traditional savings schemes. But this was all upturned by this great move to privatisation and your personal pension plans, and this great shift from state pensions and these more friendly society type schemes into the private sector, led to that big stock market boom, but also put a tremendous onus on on share value and profitability of the investment companies, of the investment banks and the people handling the pension funds. So shareholder value became very, very important, and the shareholders were things like pension funds. So in a sense, the banks were driven to reckless behaviour because their shareholders were expecting share prices to carry on rising, and look at this. The reason they got involved in this financial trading was because it was more profitable than productive investment, which was making no money at all, but slightly more profitable than treasuries, which is the safest kind of debt, which is government debt. So the United States banks bought all these collateralized debt obligations because they paid just 1% more than treasuries, than government debt. So they took all this risk for an extra 1%. So most banks were very highly leveraged, 30 to 100%. They built themselves to highly interconnected global networks. The money market had become, this was the swish of money between the financial sector institutions, the privatized pension funds who were shifting into the stock market and lending generally. And this money market became the big focus. And it was susceptible to a credit crunch if any link in the chain broke. And of course, Lehman's was the link that broke. But this all took place in the middle of a wider context of massive growing inequality, of globalization, which is very low rates of profit in the older industrial economies, and a shift of production to the low-wage economies, a big global imbalance as you've got importing nations and exporting nations. In the importing nations, jobs were not paying well. Wages were being forced down by competition from lower wage countries, and being sort of boosted up by high levels of consumer debt to keep the expenditure going. And as we know, the privatisation of money issuers, bank debt in this period became the main form of money issuers we've seen already. So debt became the main sort of source of money issues, and debt was being driven by the desire to buy all this cheap consumer goods, but also the fact that wages never went up at all. In fact, wages comparatively have declined. So people are getting poorer, but they're getting more indebted. And the inequality was huge. David Corton worked out that the highest earners in America, if you take the highest owners of the peak hedge funds, they were earning 19,000 times the average wage, personally. The median salary, the papers reported the other day, 2011, the median salary of a UK investment banker was 350,000, and several people are being paid bonuses of $1 million or so. But there's a report recently that shows how the majority of people have been getting poorer. In the UK over the last 30 years, the bottom 50% of wage earners, their share of GDP fell by 25%, whereas the top 1% of wage earners, their share rose by 50%. And if you take every £100, the bottom 50% of wage earners get £12 out of every £100, and the top 1% get £3 of every £100. So we've seen massive inequalities that has come here. We've also seen the globalisation of production to the exporting countries, China, Japan, but also Germany. And I've talked about the balance of payments problem, that some countries get indebted, other countries start accumulating vast amount of international currencies. And this gets formed then into these sovereign wealth funds, which then have to be reinvested. So you end up with countries accumulating a lot of currency, Japan and China particularly. In Germany's case, accumulating a lot of euros, and then lending them back and investing them back in the importing countries. So, for instance, Germany lends them back to Greece, and you can see the mess that Greece has got into, in the same way as China lends the money back to America and helps fund its balance of payments problem. So this is the kind of cycle we're getting into, is where countries are starting to get very much dependent on each other's currencies becoming very important, and accumulating of currencies and imbalancing currencies, which in itself is very destabilizing in a world economy. Germany's doing this in the Eurozone. The reason people like Greece are in trouble is because Germany's a major exporting country. The other countries can't compete because Germany keeps its wages comparatively low. It sucks in all the euros, and then it has nothing to do with the euros because it's a saving economy, in the sense it's not a high consumption economy. So the banks look for something to do with the money. What do? They lend it to the countries that are not doing so well in terms of production, like Greece, like the peripheral countries, like Italy, like Spain. They lend the money back to those countries in order to enable them to consume more German goods. So thus increasing their indebtedness. So the bailout for Greece isn't really for Greece. The bailout for Greece is for the French and German banks who actually lent them money in the first place. And this is why Keynes was really, really keen that something should be done to stop these unbalanced in world trade getting it unbalanced in this way. So some countries had huge deficits and other countries had huge surpluses. We can talk about that next time. Why then did the public get involved? What went on then? Well, we know that banks are a system of trust. We've studied that, and we know that they can't withstand a run, because there's no concept of reserve in that sense. The money at one level just isn't there. And if everybody wants their money at once, it is possible to print the notes to give it to them or create quantitative money. But the idea that somehow if the bank has to do it within its balance sheet, it can't do it because the money, as we understand, isn't there in that sense. The financial sector has always required periodic rescue ever since really stock markets and banking emerged. Banks were always going bust. That is just it's just a fact of life for a banking system that banks will periodically go bust. We know now that banks are underpinned by state authority, and we know the people know this because when banks go bust, private banks go bust, like IceSave, which was an Icelandic bank, went bust. Northern Rock went bust. People don't go to the private sector asking questions, they go straight to the government. They say to the government, give me my money back. Now, if a car company goes bust, people wouldn't go to the government in the same way. They'd say, oh, it's unfortunate the car company's gone bust, I'll never get any repairs for my car now, or I'll never get any spare parts. They wouldn't go to the government. They would see it as a private matter. But when a bank goes bust, they know full well this is a public issue, and people go straight to the government and say, give us our money back. And we know that because when Northern Rock went bust, we know that the Applegarth couldn't stop it, Mervyn King couldn't stop it, only Alistair Darling could stop it when he stood up and said, we back it. And that was the only person who could stop that run. So privatised money, what we've learnt about the money system is that money has been privatised, but it still remains a public responsibility. The national money supply is now based on bank-issued debt, and it's subject to crisis. State responsibility for the integrity of its national money means it has to continually bail out the privatised system. As long as it lets the banking system be the main issuer of money, it's going to have to bail it out. It can't not, because otherwise it loses its money system. And states have now had to take on sovereign debt to rescue private debt. And as I say, they are borrowed from the self-same banks and the same money markets. So we've learnt that the financial system is not private. It administers a public resource, that is the money supply system of a country. We learnt in the first, the second lecture, that we know that nearly all our money now comes out as bank debt, and we know the final resource of the money system, the only resource, as is proved in the crisis, is the taxation and money issue capacity of the states. Now, it's interesting that Iceland has refused to pay. It's refused to tax itself, to pay for the failures of its three big private banks. And it's ridden out the storm. But it's a small country, 300,000 people, and the debt was comparatively small. I mean, it was big enough, but comparatively small. So who knows how many other countries will have to say, I mean, Greece Greece is saying it can't pay its debts either. So we're going to have a lot of debt forgiveness. So the viability of money systems, what we've learned about the viability of money systems is it rests on the capacity of the state to tax or the consent of the taxed. And yet we do know that tax avoidance is rampant in the financial sector. The only thing underpinning the financial sector are states and the ability of the states to, at the moment, under our current financial system, it doesn't have to be that way, but the way it's organised at the moment, the integrity of the states is the only thing that holds up the money system. And yet the financial system is more or less refusing to pay its share of tax. It likes to hold as much as possible offshore, and it tries to, and also it demands massive remuneration, huge amounts of income, saying, oh, we'll go somewhere else. If you don't give us the money, we'll go somewhere else. Which short answer should be, well, go. We don't need you. Because we can create our own money. We do not need the debt-based banking system. That's what we've learned about money and banking. We don't need them. We can issue, we've got other mechanisms of issuing money. In fact, we've had to issue the money through quantitative easing, although it's been given to the banking sector. We know that states can create money, or at a euro, it would have to be done at the euro level, at the eurozone level. But it can be done. You don't have to issue money as debt through a banking system. And that's the biggest lesson we have to learn. So But this increase in sovereign debt has been caused by this crisis. And we know it's a serious problem in the Eurozone. And we know that this is a problem of the Maastricht rules, the way the Eurozone was built up, with the ideology of only banks, only private money is allowed. Only the banking system can create money, effectively. That's the problem with the Eurozone. It has no public conception of money. And until it's got that, it's not going to be able to be functional. It's much less problematic if the country has its own currency and borrows it. Japan, there's this huge fuss of Greek's debt, about 150% of GDP. Huge fuss. But Japan's national debt has been 200% of GDP for ages. But it owes 95% to itself. It owes it to its own banking system. And therefore, it can just issue money. It can support its own system, and nearly all its stock market is domestic as well. So Japan has managed to be more or less a stagnant economy for about 20 years, and yet it hasn't collapsed, and it has a massive national debt to itself. Why not? The Greek financial sector, in fact, is quite small. Only twice GDP, which is very small when you think of how big Iceland was at 10 times GDP. But 2/3 of its debt is to foreign lenders, mainly within the Eurozone. So in fact, if the Eurozone chose, it could just make more euros available to the Greeks to pay those debts. It doesn't owe them in Swiss francs. It doesn't owe it in dollars. It owes it in euros to the Eurozone. So in fact, it is internal. It's internal to the Eurozone system. But they're just not seeing it that way. And Greek public and private debt together is only 250% of GDP, whereas if you remember, the figures for the UK are over 500 GDP. So really Greece actually hasn't got that huge a problem. And yet it's being made this huge fuss because basically the Germans won't enable the recirculation of euros unless it's as debt. And so there's an easy solution to it, but of course they won't make it. So now we're into austerity. Neoliberal economics has constrained the capacity of states and is blaming the states now for the debts. Isn't that ironic? The British debt was about 40% before the crisis, 40% of GDP government debt, and it's now 60% without the crisis, without the financial backing, and 80% if you put the backing to the financial sector in. So we've doubled our sovereign debt, entirely to do with the outcome of this crisis. And yet, now we're being blamed, and now the people are having to take cuts. So somehow it's all become the government's fault. And yet, and most countries like Italy was the same. Italy's national debt was about 40% of GDP, very low. Most of Europe, very low rates of national debt before this crisis. All the debt that's happened is bailing out the banks. So and yet we've allowed, or somehow it's been allowed to turn back onto the people. It's become our fault for being profligate. So, as I've said before, it assumes that money can only be issued as bank debt. And it assumes that reducing state expenditure will increase private expenditure, which is absolute nonsense. The state, as we know, the state can be a money issuer, a money circulator, and therefore it can be a source of wealth. And we have to realise that the public sector is as much a source of wealth as the private sector, if not more so. Because in the end, it's the only sector that can produce money free of debt, and so that it can circulate and build up without incurring debt. And yet, as I say, states are blamed for failures of the private sector. We're being asked to cut expenditure and raise taxes to pay for the deficit caused by the crisis. But this is against the context of this incredible economic crisis that's happened. We lost 6% of GDP in 2009. Obviously, there are countries in the world that are still doing okay. But there's still an impact on them. The BRIC countries are Brazil, Russia, India and China. But unemployment is getting desperate now, particularly across Europe. Youth unemployment, 40% in Spain. I mean, huge. Greek unemployment's getting, I think, to 20% or more. And obviously we're seeing public anger I don't know where that ends. The question we can ask then is this the 1930s? How does this compare? Well, if you look at 1929 to 30, US GDP fell 40% that year, 25% the next year, 25% the year after that. Now, we're not in that position yet. Our economies haven't collapsed, largely because we've still got substantial public sectors. I think that's what's holding it. Even Greece has not lost. I've got figures there of 15% overall. I think it's more like 20% now since I put this together, because it's going up by the minute. Unemployment, though, is getting to be pretty high. But the US in the 30s had a huge debt service, 20% of GDP. We're nothing like that. And in the 1930s, nearly all the banks collapsed. Well, in fact, most of our banks have collapsed. It's just they're being held up by the rescues they've had. One big difference between now and then is that they had the gold standard up to 1933, particularly in the States. All this time we've had floating exchange rates, which has helped. I mean, the British pound lost 25% straight away, which helped our balance of payments quite well, or at least our balance of trade. But the big problem is the overall level of debt. If you take all sectors, the overall level of debt is now higher in this crisis than in the 1930s. So that's the big worry, and we're not through. I think we're only halfway through the crisis. And I think now the states are involved and the states are getting undermined, then I think we are in a very, very difficult and very dangerous situation. And it's very unclear how it's going to work out. Okay, thanks.